Welcome to this week's edition of the Monocle Banking Podcast, curated by Monocle Solutions, your weekly account of the world of finance. This week, it's all about deal making and investment banking, so let's get into it. The global M&A market didn't take off in 2024 as the industry had hoped for. Deal makers waited for an improvement in conditions and inflation, in interest rates and debt financing, and to see the effect of those macroeconomics on target performance over a substantial financial period. And of course, we had over half the world's population heading to the polls. As a result, deal activity didn't gain the anticipated momentum. Deals took longer to sign, timescales were lengthened without the typical competitive tension of an auction process, combined with more emphasis on the right financing and robust valuations and due diligence. Deals also took longer to close. On occasion, transactions were announced before the financing was secured and often faced significant regulatory clearance periods, particularly when it came to the competition authorities here in South Africa. Nevertheless, on balance, last year was a better year than 2023 for global M&A, driven by the larger deals rather than activity across the board. What does 2025 hold for M&A, particularly in sub-Saharan Africa? Last week we did see banks like JP Morgan Chase and Goldman Sachs sharing soaring profits as deal-making confidence is booming in the US. But obviously there is worry around tariffs and deficit spending and how that could drive inflation. And of course, higher rates would be a handbrake for African deal makers. Well, to find out, I'm joined this week by Funso Akere, who's head of M&A Advisory for Africa regions at Standard Bank Group. Funso, welcome to the podcast and Happy New Year. Maybe you could just start by sharing what initially inspired you to pursue a career in corporate finance and investment banking. Was there a defining moment or a person maybe who influenced the decision?
Thanks and Happy New Year. Good to speak to you quite early on in the year. I think my interest in investment banking and particularly corporate finance was kind of shaped by going through trying to solve what seemed like complex problems when I was in university. And I remember having to deal with a problem around revenue allocation in Nigeria and write a paper. And I spent quite a bit of time researching, getting data, and just putting pieces together and being able to present a paper that kind of dealt with the problems and my thoughts as to how to solve the problems. So I think I've kind of, earlier in my career, been focused on solving problems, which really is what corporate finance or M&A kind of focuses on.
With over, I believe, 24 years in investment banking now, how many years have you been in the industry?
It's ironic that, you mentioned Dealmakers approaching its 25th year. I'll be celebrating 25 years with Standard Bank Group on the 2nd of February.
Wow.
Which is in just a little under a month. And, I joined Standard Bank Group in Nigeria in the corporate finance team, February 2nd, 2000, was thrust right into corporate finance.
So 25 years along with deal makers in the industry, it's a long time to remain motivated and engaged in the industry. How has your passion evolved over the years?
I think I'm quite fortunate to have kind of seen the start of certain transactions. So for example, in 2000, and a big theme in Nigeria in 2000 was privatizations. In 2000, we had advised the company Scansem, which was a member of the Heidelberg Cement Group, on acquiring a moribund cement company in Nigeria. That company was called Cement Company of Northern Nigeria. We advised Scansem was based in Norway. We worked with them. They won the privatization, emerged as a successful bidder and ran that company. And this came full circle because a couple of years ago, we advised, the company was eventually acquired by Boa Group, and we advised Boa Group on a series of mergers, consolidation, and eventually a listing. And today, that cement company sits as the second largest cement company in Nigeria. But more importantly, when you go to Sokoto State, Kalambena, where the cement plants are located, you can see how what was once a moribund cement company in 2000 has turned to this flourishing multi-billion-dollar cement plant that's generating employment for tons of people in that location So those are some of the things that you look back and say, wow, M&A does have its impact and you get your fulfillment from there.
And it's quite interesting to look back at the early 2000s and that wave of privatization and to see how the M&A landscape has evolved through the last 25 years. From that perspective, what would you say have been the biggest evolutionary changes that have driven deal-making activity in Nigeria's capital markets over the last quarter of a century?
Yes, I would say the early 2000s, perhaps up until about 2003, were driven by privatizations where, the government of the day was trying to get companies to come in and take over kind of moribund companies or companies that were owned by government and transfer them to the hands of the private sector. Some of the landmark transactions in that era where I talked about the privatization of Cement Company of Northern Nigeria. We also advised the company on, the privatization of Nolchem, which was an oil marketing company owned previously by Shell and the government. And, 40% of Shell's stake was sold. And then we privatized, the government's stake via public offer. And that business now is a public company, which has now been renamed Cornwell. So that was a massive privatization of an oil marketing company. There were also a series of other cement companies that were privatized as well as banks. So that drove activity in sort of the first half of the 2000s. Then you then had the bank recapitalization exercise where banks had to move from $20 million to $200 million. And that drove initial public offerings. And we handled some of the largest initial public offerings at that point in time. We privatized Standard Trust. We handled the IPOs for Standard Trust Bank, which is now UBA. We handled for Zenith Bank. We did Access Bank's follow-on public offering. We did Zenith Bank's follow-on public offering. We did a domestic GDR for GT Bank. We also did the same for Diamond Bank that saw them raise, capital investors as well as domestic investors via DDR. Did, Dangote first, which was an IPO of Dangote Sugar that raised about $450 million. So these were transactions back in the days that raised anything from $300 to $500 million and really brought foreign investors to invest in the Nigerian capital markets or hold equity in the Nigerian capital markets. There were also a series of mergers that were noteworthy. For example, in 2003, we handled the merger of Unipetrol with Adrip, which created Owando PLC. Owando PLC is now one of the largest indigenous oil companies in Nigeria and recently acquired the upstream portfolio of one of the oil majors, which was a native transaction for Owando. So I would say up until sort of 2008, before the global financial crisis, we had a very active market where, people could raise, where the stock market was delivering perhaps 20% plus returns every year. GDP was growing at about 6% annually. A middle class was being created. The exchange rate was stable, and Nigeria was the darling of investors. The last thing I would talk about, kind of the 2000 to 2010 era, was that we then worked to reinvigorate the domestic bond markets and, worked with the government to create a level playing field and give tax waivers to corporate bonds. And that saw the emergence of a vibrant domestic debt capital market, which was first led by the sub-sovereigns, Lagos State government and a couple of the other state governments. And then we saw corporate bonds, the emergence of corporate bonds in the market. So I think that kind of categorizes the first decade. Now, 2010 to 2014, that was a period where we witnessed lots of cross-border activity. I mean, you remember I said that Nigeria had kind of grown at about 6% GDP every year. McKinsey came out with this report that talked about the promise of the Nigerian consumer sector, the middle class, etc. So we saw lots of companies looking at doing deals in Nigeria. Incidentally, for me, I had moved to South Africa in 2010 and we worked to build an Africa M&A team that focused on cross-border M&A transactions. And in that period, we handled a number of cross-border M&A deals, including the sale of Famous Brands acquisition of 49% of UAC restaurants, Consul's acquisition of a controlling stake in a glass force in Nigeria, Tiger Brands acquisition of Dangote flour mills, and a number of transactions where both South African and international companies were looking at really tapping into the power of the Nigerian consumer and that growth that we had seen in GDP and the stability in exchange rates. So, 2010 to kind of 2014, 2015, I call that the golden years of cross-border M&A, where every CEO for a multinational looking at Africa or an African company looking at growth was looking at Nigeria as the next frontier of growth.
On that point, Funso, I think it was 2014 when Nigeria rebased its GDP, which made it Africa's largest economy. It overtook South Africa. It got a lot of coverage here in South Africa, and we were quite upset. We've always had this healthy competition with Nigeria, be it in football or corporate boardrooms, and it was a very interesting time. And I recall quite a few CEOs also getting burned in Nigeria as well. So it really was, it was probably, as you say, the golden era. Then what happened after that? Was it the oil price crash that brought that all tumbling down?
I think it was a combination of unavoidable and avoidable factors. Incidentally, I moved back to Nigeria after 5 years doing cross-border M&A in South Africa. I moved back at the end of March 2015, which was when the new president was coming in. And, this was the first time that we had gotten a change from the dominant political party to the opposition party. So you can imagine there was so much hope that Nigeria had elected a president that was perceived to be, I'm trying to use the right politically correct word, perceived not to be corrupt and was going to deal with corruption and, move us to the next level. Unfortunately, what panned out was completely different. 2015, 2016, oil prices dropped. And remember, at that point in time, we had a peg on the Naira, and the Naira had been stable for multiple years. Well, what should I expect when there are shocks in oil prices and there's a reduction in your ability to defend the Naira? Is that the market expects a minor correction. So they expect your currency to devalue a little bit or depreciate. So I think the market was pushing for some depreciation in the currency, maybe 10%, right? Or 15%. So moving from maybe 199 to 220, 225. The government of the day did not want to devalue the currency. So what you saw was the introduction of capital controls, banning some items from the FX market. And you saw a reduction in the supply of dollars to Nigeria. So I think it was a bad policy move because people then panicked as the gap between the official and the parallel market widened and the supply of dollars contracted. There was a panic in the system and, people started taking money out or buying dollars. So that went on for about a year and a half. And towards the tail end of 2016, the government moved the currency allowed the currency to trade freely. And the currency kind of started trading at about 460 and eventually, I think, reached a landing at about 380 or something. So we had close to 2 years of there being a strain on the economy, FX liquidity crunch, etc. But overnight, that was all resolved and we moved into 2017 and the Naira was trading freely at 380. Funds were coming back into the market. The sign of people had started to look at deals again. Investors have started to look at Nigeria. And, we handled a number of M&A deals in that period. So people just assumed that, that was over and it was back to business as usual. However, the government wasn't very pro-market. A lot of investors got frustrated because they didn't have access to decision makers the same way they had access to decision makers in the 2000 to 2010 period. So I think it was probably a government that kind of felt like they wanted to do a lot themselves, probably socialist leaning as opposed to capitalist leaning. And that kind of affected cross-border M&A activity in the market, but we had stability in the FX in the naira for the next 2 years.
And then we have, if we fast forward to where we are today, President Bola Tinubu, again, with the suite of reforms, one of them being exchange rate unification. And if you were to look at those reforms, probably some short-term pain for long-term gain. How has that most recently impacted the M&A market in Nigeria?
I mean, I think it's been tough. The last administration, the scale of the problem had increased in size. So, I remember I talked about the currency ended up at 460. In 2019, we then had another crisis that lingered on until this new administration came in 2023. So he had to take some very difficult decisions. And those decisions, any one of those decisions is difficult in itself and will need a series of measures to cushion the impact. One was removal of subsidy. The second was changing the exchange rate regime and allowing it to trade by the forces of demand and supply. And then the third was the liberalizing the tariffs for electricity so that you can encourage more generation and have people have power that meets their needs. Now, all that has had an inflationary impact. For example, the currency currently sits at about 1,500, 1,600, which is a 4 times increase from what the official exchange rate was back a couple of years back. Energy tariffs have gone up significantly, and obviously the cost of petrol has gone up significantly. But those are important things, decisions that need to be made. When I was in Cape Town over the festive, it cost me twice as much to buy petrol per liter as it currently costs in Nigeria, which kind of points to the fact that, there's probably still some more work that needs to be done. But I think we're moving in the right direction. And hopefully the government can use the savings from all these initiatives to focus on projects that will generate returns in the near term. But these are difficult decisions that have to be taken.
I mean, that's the macro environment. As we look to the future, what are your predictions for the M&A environment in Nigeria over the next 5 to 10 years as these reforms start to take root? And which sectors do you believe will continue to dominate? Clearly, oil and gas has always been very strong in Nigeria. I know Lagos has become a bit of a tech hub. Do you expect that trend to continue?
Well, absolutely. I think a couple of things that will shape the M&A sector going forward. I'll go to, since you talked about oil and gas, and there have been a couple of transformative oil and gas deals where we've seen indigenous companies acquire assets that were previously owned by IOCs, and these deals are, billion-dollar deals. I talked about Owando, Renaissance, we understand has gotten the nod on acquiring the Shell portfolio from the press. These are companies that over the next couple of years, Seplat has completed the ExxonMobil acquisition. Those are very large portfolios of assets that need to be developed. So you can imagine the kind of activity that we expect to see in the sector going forward. So upstream, midstream, oil and gas, that's going to be an important, sector to look at going forward. And we'll see lots of activity. On the downstream sector, Dangote refinery is up and running. That's going to hopefully see some consolidation in the industry. But lots of M&A activity we expect in the oil and gas sector going forward. I haven't even talked about gas actually, but that's probably topic for another day.
Yeah.
We expect to see lots of investment in gas infrastructure, lots of investment in monetizing, the gas opportunity just because of the ESG considerations. If I move to the power sector, we think that there is, some consolidation, bringing in of new capital that would happen in the generation and distribution space. And we're seeing some activities. We think some of those assets will change hands because the previous owners have owned them for a while. We're seeing the emergence of infrastructure funds looking at taking up assets that, provide stable long-term returns. So we'll potentially see activity from infrastructure funds going forward. On the financial sector, there's another round of bank recapitalization. The banks have gone out first round to raise capital. We've been very active and have worked with a number of the leading banks in trying to raise capital from investors via follow-on public offerings or rights issues. Again, after the round of capital raises, we think there will be some consolidation in the industry, larger players picking up the smaller players. On the consumer sector, we're seeing some multinationals who have owned assets for a while need to rebalance their portfolios and maybe sell some of those assets. And one of those recent examples was the Diageo sale of its controlling stake in Guinness Nigeria to Toleram. We advised Toleram on that transaction of its controlling stake in Guinness Nigeria to Toleram. We advised Toleram on that transaction and also provided acquisition funding. And now Toleram is the controlling shareholder in Guinness Nigeria, which is a company that has such a rich heritage in Nigeria. So we think, some of the multinationals will divest. We think there will be private equity firms who have held on to assets for a number of years will now look to exit their stakes in some of these assets that will drive M&A activity. On the TMT side, obviously, digital infrastructure continues to be an important theme, and we think there'll be activity there. We're seeing fintechs continue to pick up market share. I think MoneyPoint has recently joined the Unicorn Club and, closed its funding round at, over $1 billion valuation. That's a business that plays a unique role in democratizing access to financial services in Nigeria. So there's lots and lots to unpack. But more importantly, we're also seeing some of these themes play out in many of our markets across Africa regions. For example, in Kenya, we're advised on the sale of the Lipton tea assets in East Africa, which is a transformative transaction for the communities in which the tea estates are situated. We're seeing lots of interest in East Africa, giving its relatively stable exchange rate in many of the markets, Kenya, Tanzania, Uganda, as well as, the low inflation rates in those markets. So I think East Africa is the darling of investors now, and we're seeing lots of interest in East Africa. Ghana has just gone through a successful election where there's been a change in the political party. We think that there will continue to be interest in Ghana as people look at West Africa. Exciting at the Francophone West African countries. Cote d'Ivoire, for example, is one that a lot of our clients are really looking at and are excited about. And we have a presence in Cote d'Ivoire. Yeah, so lots of themes to unpack across various sectors in many of our markets. I haven't talked about Zambia, but Zambia, there is some good opportunity in Zambia, but lots to unpack across many of our markets.
It just underscores the dynamic nature of capital markets in the region and the opportunity that exists from country to country and potentially with overlapping themes for intra-African M&A to continue to increase. When you look at your personal journey over the last 2 decades plus, is there one transaction that really stands out for you as career defining? I know it's a difficult question. There are probably a few. But if there is one, maybe you could share what that might be and what made this deal so significant and the role that you played in it.
That is a tough one because I think I've probably worked on well over 100 transactions and they've all meant something to me at various stages in my career. I think that there are maybe 2 or 3 transactions that I'll maybe just quickly highlight. I think the Dangote Sugar IPO was one, and that was Dangote Sugar IPO in 2003, where I mentioned we raised about $450 million, was one because it was market defining. And it was in one of those transactions where I had kind of worked for about 3 years, so I could really get hands-on involved in the transaction. And it was market defining because we were able to raise capital from the international market but have international investors participate in the local capital market as opposed to having, the company dual listed. And that attracted a suite of investors that we were then able to also get to invest in a wave of transactions, public offerings up until 2007. So I think that was market defining. Another transaction that I kind of looked at and went full circle was the work that we did with Presco. And that started out in 2000 from doing a private placement. Then we eventually took Presco public in 2001, 2002, and then came back 2 decades later to do a series of transactions that involved Presco acquiring SEA and providing acquisition funding for that acquisition, and taking Presco to the debt capital market for the first time to raise funding to then repay the acquisition bridge that was provided. And that allowed Presco shareholders upstream cash to then repay debt obligations to European banks that were looking to rebalance their portfolios. And working with a team that I worked with 2 decades ago, and seeing how that business had grown in the space of 2 decades, that for me was one of those full circle transactions. And then obviously the cross-border transactions. I think this Toleram Diageo transaction is transformational for the market. And it's one transaction that the market will talk about for the next 5 years or something.
Just as we reach the end of our time, Funso, there's so many deals that we could probably spend a couple of days talking about all of them. But it also it highlights the important role and impact of M&A and the work that you're doing in building economic prosperity across the African region. It's got huge societal impacts. It's vitally important work, very challenging work when you're dealing in markets with currency fluctuations and having to structure transactions to get around some of those challenges. When you reflect on your career journey, is there a personal philosophy or core set of values or a mantra that has shaped your success so far? And then also, if you could go back sort of 25 years and give yourself one piece of advice, what would it be?
Yeah, so I think if you put your client first, and we use a time which we call client centricity. So if you put your client first, or the interest of your client first, it will serve you well. And that's something that I was taught in day one in investment banking when I joined 2nd of February 2000. And that's something that I think about every single day when I wake up. What does the client want and how can I serve my client best? And if you have that at the back of your mind every day, then that I think for me is the most important thing. And that's what clients will remember 10 years down the line. This person actually worked as if this was their company. It wasn't about the fees. It was about ensuring that my deal was successful, or I made the right decision and I was able to achieve my strategic objectives. So I'll say put the client first. The one thing I would, if I had to go back and say to myself at the start of my career, is that nothing is impossible. However difficult something seems, just start it. And, life is about putting one foot in front of another and take one step and take one step and take one step. So if you just keep chipping at something, you will solve it. Because many times we kind of say, well, maybe I'm not ready for this. Maybe this seems too daunting. Do I think we'll win this deal? Just go for it. Give it your best shot. Don't go for it unprepared. Because people kind of think when you say go for it, it means, just show up. No. Actually, you have to cover the ground. So if it means that you have to spend one night preparing and you don't have any sleep just so that you show up prepared, do so, but go for it, put your best foot forward. And I think more often than not, the stars align in your favor.
Well, thanks, Funso. I think great bit of advice to the next generation of deal makers there. Well, that's a wrap for this week's episode of the Monocle Banking Podcast. As always, brought to you by Monocle Solutions, your trusted guide to the world of finance. A big thanks to my guest, Funso Akere. As we've heard, while deal making last year required some patience and precision, the outlook for this year presents a far more favorable environment. If you've enjoyed this discussion, don't forget to subscribe, leave a review, and share the episode with your network. You can also follow Monocle Solutions for more in-depth financial analysis and expert commentary. Until next time, I'm Michael Avery, signing off.